And we're expecting quite a bit of commentary at the Kansas City Fed's Jackson Hole Symposium this week. Alongside that, minutes from the Fed's late July meeting due out this afternoon. Joining us now on what we should be watching, Neil Irwin, chief economics correspondent at Axios. Soft landing back. Is it a little softer? Is it semi-soft? Is it actually trending back to hard again at this point, you think, Neil, if we get a revision down at 10 a.m. on some of the jobs numbers that we've seen?
Yeah, you remember this FOMC meeting that we get minutes of this afternoon? That came 2 days before those really weak July jobs numbers. So the minutes are always a little bit stale. They're extra stale this time. The revisions you're talking about, the benchmarking, that it looks like is going to tell us that job growth has been weaker all along this last year and a half in a way that maybe changes, as Mike was saying earlier, kind of the perceptions of how strong this labor market really is. So, yeah, I think you're right. I think all the signs are pointing to a labor market that's not nearly what it was a year ago or 2 years ago, and the Fed's probably going to react in September.
Can it be almost in a good way, Neil, for the markets? That's what I mean, because we're in the same. Even if we find out that the jobs numbers weren't as good as we thought they were, we still have a pretty good idea, GDP-wise, where the economy is, and it almost seems like that could be taken as like almost half full, because it gives the Fed some leeway to go ahead and cut and maybe eventually cut again and again, maybe do the 100 basis points eventually, or 125 that were in the market a year ago. Could it be good?
Yeah, I think so. I think you're exactly right. The kind of overheated job market, to the degree that was the narrative 2 years ago, it just isn't anymore, and the revisions, the benchmarking should kind of confirm that. But I think, the Fed liked to say, Powell said 3 weeks ago, that they're not data point dependent, but data dependent, meaning they're not looking at any one data point. That said, to the degree they're data point dependent, this coming jobs report on September 6th, 2 weeks from Friday, is really, really important for what they end up doing in September. That weak July number on unemployment really got some attention. If that keeps moving up, then they might have to kind of break the glass and go more aggressively than they had wanted to.
Yeah, I'm just wondering whether that was a total outlier that sent the VIX over 50 and really got people thinking, wow, they are late. They're almost too late. And a couple of firms raised their recession odds. I think they went back down. But is that still a possibility that we could be in that mindset again, that the Fed is late to cutting?
Absolutely. I mean, they sounds like they were kind of really on the fence on whether to cut in July. They did not do it. You have to imagine there were some people in that room who thought they should have cut, and when they got that jobs report 2 days later, kind of had a sense of the told you so sense of things. I think the question for this September meeting coming up in a few weeks is, are they behind the curve? Do they need to cut 50 basis points and catch up? Or can they go with the plan, which is 25 basis points at a time, kind of a mid-cycle adjustment? And that's why this incoming data is going to really tell us, is this sky falling on the labor market, or are things just coming in for this extremely soft landing we've seen the last couple of years?
Have you seen anything, Neil, at the micro level in terms of either credit quality at banks or retail spending by consumers, whether it's high end or low end? Have you had anything that looks to you like we're being fooled about how strong the economy is, or is it's pretty good? It's a soft landing.
Yeah, look, I see a lot of warning signs out there. The credit card and auto loan delinquency is up quite a bit. We see something in the JOLTS data, for example. The hiring rate is substantially below the rate it was before the pandemic, about half a percentage point. If you look at the kind of anecdote data from big companies that sell to especially lower income consumers, they're definitely seeing kind of price sensitivity in a way they didn't this time a year ago. Now, does that turn into a recession? Not necessarily, but it does tell you that something is cracking a little bit in the economy, and the Fed, if they don't start moving, will definitely be behind the curve if that happens.
All right. It's a dismal science, Neil, but you study it closely. So I had a question the other day. There's that rule that if unemployment rises, what is it, a half point from some level, then you can expect a recession at some point. We were already there, yep. But we were at such low levels historically that I don't know if it really counts when you go up. What would the unemployment rate, what is it, 4.2 now? Or I don't know. Where would that have to be for you to say, okay, we have a problem? Like 5%?
Yeah, it's not. Look, it's not the rate in isolation. It's the direction of travel, and that's what's alarming. You mentioned the SOM rule. Look,
SOM
the
rule.
unemployment rate. Yeah, unemployment rate was 3.7 back in January. It's now 4.3. That's a pretty big move over the course of 7 months. If it stabilizes in the mid fours, that's great. That's still a quite low unemployment rate. Nothing wrong with a 4.5% unemployment rate.
Right.
But if it keeps marching up, and that's what the SOM rule is about, that when it starts moving up, it tends to not level off, and that's what's worrying. So yeah, if we level off at 4.3, 4.5. No problem. If we end up going past 5, then you're in a situation where you probably are in a recession and it's hard to stop.
So right now, if you were applying the rule strictly, we'd already be there. Is it a half a point?
Yeah, half a point over the 3-month average.
You're saying
so yeah, we're there.
It was low enough to where a half point isn't really. If it stays here, it's still okay. It's because you're talking about what are you? You're talking about one from 3.7 to 5 is 1.3 points. So that's like double or more than double what you'd typically need.
Yeah, the problem is these kinds of rules are based on the entire, modern economic data only goes back to the late 1940s. Only 11 economic cycles, 12 economic cycles. So the idea that something that has applied in the past will definitely necessarily apply in this very strange business cycle we've been in with the pandemic, we just don't know. We
don't even know what a recession is, and whether it's 2 quarters of, that's why. Economics. Is it a science? I'm not really sure.
Not quite.
Yeah, not quite.